Hello and welcome to the Modern Wealth Educational Series, where we'll be covering all the market action from the third quarter. I'm your host, Stephen Tuckwood, Director of Investments. Let's get going. The US stock market delivered another strong quarter in Q3, up over 8%. That was following a almost 11% gain in the second quarter. The first quarter was a little choppier. We had the big drawdown in March, but all in all, combined together, we're up almost 15% on a year-to-date basis. Within Q3, you can see July and August about the 2% range, and then a really strong showing in September, up almost 4%. So a very good year so far. Let's hope this can hold throughout 2025. Take a look now at the journey. This is the S&P 500 price index over time. Beginning at the start of the year, you can see we got off to really a nice start, just kind of grinding higher. And then obviously in April, we had the tariff announcement, and that caused quite a bit of turbulence and volatility in the equity market, and we drew down a fair bit. But really from that point, it's been from the lower left to the upper right. We've just been grinding higher and higher in this bull market, and are now touching all-time highs and have done so quite a few times along the way. So yeah, up almost 15% year to date, and been relatively a smooth journey since the April announcement. Let's dive a little bit deeper now and look at the sector performance within the S&P 500. On the left, just to put some context around it, we've broken the S&P 500 down into the various sector weights. So you can see just the size of the boxes here. The technology sector is far and away the largest sector within the index. And then to the right, the third quarter contribution. So we got 8.1% from the S&P 500, but where did that come from? What sectors contributed to that? Really, again, driven by technology. So any strong returns there, given the large weight, do tend to contribute quite a bit to the index's performance. So interesting to see that, and also a warning sign that if we do have a big sell-off in technology, that will likely drive the whole index a lot lower, just given the proportional weight there. In the lower section of the table on the right, you can see the performance of each sector as well. So only one negative performing sector for Q3, and that was consumer defensives. And the again, the best performer was technology, and then communication services pretty much tied there. Looking at the index just a little bit differently, or the stock market in general, here we're breaking things down by size, the size of companies, large and small, and then by value and growth, their descriptors. And you can see that on the left-hand side, the third quarter, it was really small caps did a lot of the catch-up work, which was good to see, a really widening of breadth across the market index. In the large side, it was a growth story versus value, growth outperforming again. And, that tends to be the case, again, when technology leads things, that technology, large cap growth go hand in hand. And, similar story year to date, growth, large cap growth has been the driver, but, there's some contribution too from the value side. So we are starting to see a bit of a widening out in the performance of the US stock market, which is encouraging. We don't want to be a narrow market driven higher just by a few companies. So the breadth is important. Looking outside of the United States, it's been a particularly strong year for other stock markets. So, in blue are the different performances for Q3 for these different markets, and then in the yellow color, the year to date. So, Canada almost 27% year to date. Similarly, in the UK and France, Germany, really strong, up almost 33% year to date, although flat to down for Q3, but just had a really stellar start in Q1 and Q2. Brazil doing really well, up almost 40% in dollar terms, and emerging markets also hanging in there. So, up quite a bit in China, particularly. India's has been negative, both on a quarterly basis and year-to-date basis, so some issues there. But just generally, a really strong period for non-US stocks, and a real reminder of why it's important to be globally diversified. Here in the United States, US investors tend to have a home bias. We like things that are familiar, and that has worked in our favor, frankly, for quite a few years, but this year has been a real turnaround where we've seen relative outperformance by the stock markets outside of the United States. Let's switch gears here and focus on the US bond market. The US aggregate bond market up 2%, which is a really strong quarter for a fixed income index. Treasury bonds, mortgage bonds, corporate bonds, high yield bonds, all doing similarly well. So year to date, the bond market is up 6.1%, and that's been a refreshing change from the prior few years here, where fixed income has come under pressure with rates having moved higher. So as rates go up, the value of bonds goes down, and vice versa. So it's been a tough environment for the bond index over the last several years, but we've started to see that turn around. So the bond side of investors' portfolios has been quite good as well this year. Some big news back in September as the FOMC met to make another rate decision, and they finally made their cut after holding out all year, staying steady, holding, and then finally made a cut in September's meeting. So the big question now is, for the remaining meetings, we have 2 more this year, obviously a lot more in 2026, but is the Fed on a rate cutting cycle, or is this more of a cut and hold? We're seeing some indication that they will embark on further cuts. Listening to commentary from various different Fed officials, there seems to be signals here that we should be expecting a number of cuts into the near future. So that bodes well again for fixed income generally. When the base rate is headed lower, it tends to help the rest of the curve, but not always. The longer dated bonds are independent from the federal funds rate, which is the base rate that the Fed is controlling. And it doesn't always work that the Fed lowers and then, let's say, the 10-year Treasury lowers. There can be some divergence there, and they operate in different ways. But in general, it's good for the base rate to be headed lower for rally rates across the curve. Creates a nice environment for that to ease lower. Speaking of rates and expectations, let's look at the dot plot, the projected federal funds rate. This comes from the Fed statement, the summary of economic projections. These are the different Fed officials and how they're indicating or forecasting rates into the future. So one individual had a hike for the rest of the year. Not quite sure which Fed official that is, but certainly not consensus there. 5 members expecting no more cuts this year, but 9 or so consensus are in the 2-cut realm, which I think was a positive for the markets to see that. Looking at a little further into the future, these aren't often great predictors of what actually happens, but it's interesting to get a lens into the Fed members' minds here and how they see things. And it is a progressive move lower throughout 26, 27, and 28. And then longer term, looks like the consensus is, or the average is, around 3%. We'll obviously see how that plays out. The main factor working against rate cuts is inflation, and that's the dual mandate that the Fed has to operate within. Price stability and maximum employment can be in conflict. Always interesting to see which of those the Fed is focused on the most at any given time. All right, so those are the FOMC members' expectations of future rate cuts. Now let's turn to what the market expects. So here we're looking at SOFR futures, so a short-term base rate, and the futures market, so what the expectations are. And you can clearly see in orange that there is an expectation of the market of additional cuts, several into the future. So to the extent that the Fed disappoints the market by not delivering those cuts, could cause some turbulence into the future. So it's looking relatively baked in from a market perspective, but again, the Fed does need to then meet that expectation, or we could see some level of turbulence. So all in all, a great quarter for risk assets, both on the equity side and the fixed income side, making those balanced portfolios have a particularly good time. What Q4 will bring, we don't know, but we will be monitoring it very closely and keeping you all apprised. Thanks for joining us for this quarterly update, and we look forward to seeing you in the future. Take care.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.